Hello and welcome back to another episode of The Mortgage Musketeer, where today I'm going to be dispelling a lot of the myths that you hear about mortgage insurance. All right, so here's what we really need to think about is, first of all, what is mortgage insurance? And here are a couple of different types of mortgage insurance, PMI or whatever. It's private mortgage insurance versus something like where you're dealing with an FHA loan where you have mortgage insurance on a loan that is required for the government, which is why you can get a loan if you don't meet conventional requirements. So mortgage insurance in itself gets kind of a bad rap. And I kind of wanted to review the numbers with you so you actually understand the math behind it, so that instead of being emotional, because I hear it all the times, and 99.999% of the time, I hear it from the buyer who says that their parents said, no matter what, don't get mortgage insurance. Okay, let's think tactically and not emotionally. All right, so mortgage insurance, what is it really? The idea of mortgage insurance is actually to protect the investor, because you can put as little as 3% down on a home. If you put 3% down on a home, then essentially you only have 3% skin in the game, whereas the investor has 97% skin in the game. So if you were to walk away and the house were to foreclose, you'd only lose 3%, and not a big deal. But the investor is stuck with 97%. And because it goes into foreclosure, there's a lot of expenses that go with that. And then time before that house can be sold, it's a big loss for the investor. So anytime that you don't put 20% down on a home on a conventional mortgage, it's going to require mortgage insurance, usually. Okay. There are some ways to avoid mortgage insurance. So you can actually take a slightly higher interest rate, and that would eliminate your mortgage insurance, or you can buy it out up front, or there's 50-50 splits. There's a whole bunch of different ways to sidestep mortgage insurance. However, I would make the argument that sidestepping mortgage insurance may not be the smartest thing to do. As a matter of fact, I would make the argument that for all of you trying to save up and wait to purchase a home so that you can save up enough money so that you can avoid mortgage insurance, are actually making a tactical error with your money. What do you mean, Sean? Why would that be a tactical error? Why should I buy a house with mortgage insurance? I'm glad you asked. Let's look at the numbers. All right, so if we look at a $300,000 home and we put 5% down on this home, all right, what would happen? So we would have basically 5% interest in this house, whereas the lender has 95% interest. Well, that means you're going to have mortgage insurance until you reach an 80% loan to value. So until you pay down enough on the mortgage to reach an 80% loan to value, you're going to be carrying that mortgage insurance. Now, the thing that you need to understand is loan to value. That means as your house appreciates in value, that means that the risk to the investor is less, and that means that you can actually request to have your mortgage insurance removed once it reaches an 80% loan to value. Notice I didn't say you had to pay it down. I just said it had to be an 80% loan to value, which means in a market where your houses are appreciating at an astronomical rate, you could very well have enough equity in your home to eliminate mortgage insurance in just several years. Okay, so if the market was stagnant and it didn't appreciate at all, then on average, the way the math works out is somewhere around 8.5 years, your mortgage insurance will drop off. Okay, well, let's talk about saving up for mortgage insurance and how much it really is. So if you looked at that $300,000 home and put 5% down, I think in people's mind, they think, oh, mortgage insurance is like $200, $300, $500. It is $69 a month. $69 a month if you put 5% down. That's it. So I based this number off of a 740 credit score on a $300,000 home with 5% down. That's it. Okay. If you have a lower credit score or different numbers, that can change a little bit, but these are the numbers. They're not that bad like you think they are. Okay. So now let's compare that to rent. So if your average rent is, say, $1,400 a month, $69 a month versus $1,400 a month paying rent while I save up enough money to put a down payment. All right, so if you were actually look at that, you look at $79 a month, which is $828 a year, versus $16,800 a year that you're paying in rent. So why in the world would you wait a year to try and save up money, which it would probably take you more than a year, right? But why would you wait all that time when you can just pay $69 a month? $828 a year versus $16,800 a year, where then you can get into your own home, be paying down your own equity, have a return on investment, and I'll show you the video I just did on that right up here. But you are wasting a ton of money. And this is another one of those things where I have people that are tripping over dollars to pick up pennies, right? $69 a month versus a $1,400 rent. It just mathematically doesn't make sense. You're talking years and years, where you could be saving a ton of money. Now, let's say that you even put 10% down. Okay, so what is the difference on that? So if you put 5% down, that's 15 grand on a $300,000 home. If you put 10% down, that's $30,000. So it's still 10%, it's not 20, so you're still going to pay mortgage insurance. So what does that mean? Well, mortgage insurance, if you put 10% down, is $47 a month. So wait a minute. You're going to put an additional $15,000 down so that you can reduce your mortgage insurance by a little over like $22 a month. Okay? That is the difference in the recapture value. So if you took the $22 savings for putting an additional $15,000 down, the recapture value on that is 681 months. That's 56 years. So does 15,000 versus 30,000, does putting an extra 15 grand down make a lot of sense? Not as far as mortgage insurance is concerned. Now, there's other factors like what is your monthly payment, and a whole bunch of other things that you're looking at potentially. But, and those are numbers that we can break down. But if your sole thought is, I want to put as much down to avoid as much mortgage insurance as possible, your thinking is wrong. Okay? Mortgage insurance is not as bad as you would think on a conventional mortgage. Okay? I hope this helps kind of dispel those rumors. Now, while I'm on this subject, let's talk about FHA, VA, and USDA. These are your government loans, and they're government loans because basically they're government backed and they're allowing you to get into a home that you normally wouldn't get into. First and foremost, you have your VA loans. There is no mortgage insurance. There's an upfront funding fee that covers that, and then the government actually backs the loan. And that's why those are really powerful loans for investors, because they don't have to worry about default. If it's default, the government takes care of it. But you got to be a veteran in order to do that. And then you have USDA or rural housing. USDA and FHA both have what's called an upfront mortgage insurance premium. And that means a certain percentage is charged up front against the mortgage insurance in order to reduce your mortgage insurance. All right. So if you were looking at as of today, which is in August of 2022, the current upfront mortgage insurance premium for a USDA loan is 1%. And then the monthly is 0.35%. Okay. And then for an FHA loan, there's an upfront mortgage insurance premium of 1.75%. And then the monthly mortgage insurance is 0.85%. Okay. And those percentages allow you to get into a home that you wouldn't normally be able to get into. And what usually happens is people buy their home, they own their home for a period of time until their financial situation changes, they get more money as far as income is concerned, they reduce their loan to value, and then they refinance into a conventional mortgage. Very, very common. Okay. The loan that is best for you is the one that gets you out of paying rent every single month. Okay. So hope this helps understand how these different pieces work. But if we're talking about specifically a conventional mortgage and you're worried about mortgage insurance because everybody, your brother, your sister, your parents have all said you need to avoid mortgage insurance, think tactically. Look at the math and make sure it makes financial sense. Until next time, it's all for one and one for all.